so that if you ever want to go back and reference it, I will have a website for you to do that with. So let's get started, shall we?
We are Guaranteed Rate, a group of over 5,000 slightly obsessed mortgage-loving people driven by the belief that getting a mortgage should be an awesome experience. We're driven by technology, powered by humans, fueled by positivity, and guided by the belief that everything we do starts and ends with the customer. Which explains a lot, like how we've grown from a startup to the third largest retail mortgage lender in less than 20 years. It explains why we invented the world's first all-digital mortgage that's simple, safe, and celebrated by NerdWallet. It explains our suite of simple digital tools that respect your time. Putting the customer first is why we have over 150 different ways to get you the precise mortgage you need, and more top-ranked loan officers than any other company to guide you to the perfect one. It's why we treat employees like the rock stars that adorn our walls, why we have a stadium that supports America's pastime, and why we have an employee-driven foundation dedicated to helping people experiencing hardships in the very communities we serve. When you put the customer first, it's no surprise 96% of our customers would recommend us to their family and friends. Because we believe that when you treat everyone, from customers to employees to partners, like you treat your family, you end up with a lot of friends. We're Guaranteed Rate. Positively different.
Hey, thank you, Guaranteed Rate, and hello everyone, and thank you, and welcome to Texas First Time Homebuyers class, where we are going to cover this evening 5 big mistakes to be aware of when buying your first home. My team and I are excited to have you here this evening, and look, I thought we'd start with something really, really simple, because maybe it's not so simple. We believe, or we think we know what would qualify as a first-time homebuyer. But that definition is far much broader than the ordinary definition that most of us think about. And it is generally a person purchasing their first residential property who has never owned a home, or a person who has not had an interest in a home in the last 3 years. In addition, though, an individual who is a displaced homemaker or single parent is considered a first-time homebuyer if they had ownership interest in a principal residence other than joint ownership with a spouse during the preceding 3 years. So that is the definition. As you can tell, it's broad and encompasses a lot of other people besides people that have never, ever purchased a home. So how you feeling? Maybe a little stressed, maybe about the loan process, or, for me, it's the idea of owing so much money. Are you feeling uncertain maybe about closing costs, down payment, and having to owe so much money? That would be me. Or concerned about qualifying or be approved, or maybe just anxious about owing so much money. Well, I'm here to tell you that being anxious is normal. It's a normal emotion when buying your first home, and I believe it is well within your power this evening, and it starts this evening with education to become a successful home owner. I can also share with you that I see real housing security in the marketplace today that I haven't seen in, gosh, it's been, well, I've seen it through my career, but it's just far more pervasive today than I've seen in my career. And I don't think waiting is the answer. I believe that if you can find a way to qualify, find a way to put together what you need to become a homeowner, it creates security, housing security for you and your family. Homes were 48% less expensive when pre-COVID. And even despite that, we still see prices rising. So our agenda for this evening is the five things that we're going to cover. Is number 1, not knowing the different first-time homebuyer incentives and down payment assistance programs available to you. Number 2, not having a loan approval before making an offer. Number 3, working with a bank or a credit union that doesn't have as many 5-star reviews as Mortgage Mack. Number 4, buying directly from a builder real estate agent. And finally, number 5, why you should never skip the home inspection. As I mentioned earlier, submit your questions via the chat. We will have a Q&A halfway and a Q&A at the end. And my name is Mortgage Mack, and I'm your host, and my first name is Mortgage, and my last name is Mack. And if you don't believe me, just go Google #Mortgage Mack, and while you're there, check out my nearly 100 5-star reviews from past clients and real estate agents. I personally have over, let's just say I've been in the business since June 1, 1993. I don't want to tell you how many years. I don't tell anybody how many years because it makes me feel old. I am from Orlando, Florida originally, but I grew up in a small town, Louisiana. But, I've been a Texan since 1993. I'm a 7-time Ironman finisher. I used to be a former guide for blind athletes way back when I was younger. And hey, my mission is, in our relationship, can be summed up to E to the power of 3. That is to educate you, to empower you to make good financial decisions so that you have a experience with us that compels you to want to refer me and my team to your friends, your families, and your coworkers. And finally, I am Vice President and leader of Team Mortgage Mack, aka Granddad. So what are the steps to home ownership? So we're going to start with knowledge. And that started this evening by getting educated, as we talked about. And in even furthering that education, if you'd like even further, I have a free first-time home buyer guide for anybody that would be interested in that. Second, hey, you got to get pre-approved today. It's super competitive. And that means, you got to put your paperwork and get approved. Next is, hey, let's go house hunting. And finally, let's move into your dream home. And look, if you don't have a real estate agent, I work with some very experienced, very caring, very knowledgeable real estate agents. I'd be delighted to refer you to one of those people that I've worked with for many, many years. And I want to reiterate how important it is to have a real estate agent. They perform many, many services for you as a buyer, as well as for the sellers that they serve. So let's start with mistake number 1, unaware of down payment assistance programs. And look, as a top national lender, Guaranteed Rate offers just tons and tons of down payment assistance. And even as a top national lender, we have access to programs that maybe other loan officers don't. But here's what I can tell you about down payment assistance. And here's why I think it's critical for you to be aware. I have a couple closing on their home Friday. They were sent by the real estate agent to a loan officer who, quote, got them pre-qualified. They wrote a contract on a house. A week into the contract, they were told, you don't have enough money. Well, in my book, that loan officer didn't do the due diligence up front. That should have been, that should have been told to them before they wrote a contract on a house. And the only solution that was offered was, hey, go find another house or get more money. And so they went to school with a real estate agent that I do business with. He contacted somebody or a friend of his on Facebook, and they referred him to me. And I visited with them. And the only issue is that, hey, they were hardworking. They saved their money. They had reasonably good credit. They just needed a little help. And we were able to find a solution using down payment assistance program that we're going to talk about this evening that offered them up to 5% of the sales price, 5% of the loan amount towards the down payment and closing costs. And the unfortunate part of that story is the first home was absolutely just a fantastic house, had a river right beside it. I was already making plans to go on fishing with the owner. So here's some samples of just some of the DPA programs that we offer here at Guaranteed Rate. There is the My First Texas Home, which is offered by the Texas Department of Housing and Community Affairs. It can be combined with conventional FHA, VA, and USDA loans. We're going to talk about those. Has down payment assistance that generally runs from anywhere from 2 to 5%. There is the Texas Homes for Heroes, which I get lots of calls on, and that would include police officers, nurses, teachers. But there's also another aspect of this program that's called My Sweet Texas Home, and it offers down payment assistance from 3 to 5% using conventional FHA, VA, and USDA. Oh, and here's a brand new one, just came out this year, and you know, Fannie Mae literally is giving away money, and they're giving away up to $8,000 in the form of a grant. And what makes this program different is it's not based upon where the home is, it's not based upon your income, it's based solely on whether or not you're a first-time home buyer, and secondly, whether or not you live in a designated area by Fannie Mae. Another really good program that I've been utilizing for lots of folks is Borrower Smart from Freddie Mac with grants up to $3,000. And one of my personal favorites is called Mortgage Credit Certificates, but I've done some research on it recently. Very limited, only through the Texas Department of Housing and Community Affairs could I find that product. And finally, local down payment assistance programs that may be available through your city and your county. So here's a sample of down payment assistance scenario. There was a sales price. So let's hypothetically say sales price was $243. The down payment assistance is going to be 5% of the sales price. The minimum down payment in this situation is 3.5, which is $8,505. The total loan amount for this borrower would have been $238,598. And finally, the down payment assistance offered to them was $12,150. So the difference between the down payment assistance and the minimum down payment was $3,645 left for closing costs, taxes, and insurance. So the types of mortgages that we are going to discuss this evening are, number one, FHA, number two, conventional, number three, USDA, finally, VA, which is for our veterans.
Worry you don't have the funds to buy your first home? Well, don't lose hope until you've checked out all the many programs and resources that can help. Like FHA loans, USDA loans, VA loans, Fannie Mae loans, Freddie Mac loans, the FHA Energy Efficient Program, Freddie Mac Home One, the Chenoa Fund, Community Seconds, and the FHA 203K program. Then there's the National Homebuyers Fund Diamond Program, the VA Renovation Program, Fannie Mae Home Ready, Freddie Mac Home Possible, and even a federal penalty waiver for buyers who tap into their IRA account. Not to mention all the many, many other programs on the state level. And the best way to get a handle on these resources, just call, text, or email your guaranteed rate loan officer today.
Ta-da! That would be me. And hey, this is, so this slide is about FHA, and FHA is a government insured mortgage, and it's administered by HUD, and some of the details associated with that program or some of the benefits are, and as you can tell from the video, we offer much, much more than that, but we are just going to cover these four. And so some of the benefits associated with FHA is a low down payment, 3.5% down to a 580 credit score, subject to approval. We will currently go down to as low as a 500, but it does require a down payment from the borrower's funds. It does have some simpler refinancing terms or options in case interest rates decline from where they are today. Lower mortgage rates than some typical conventional loans, especially if you find yourself with, you know, a good credit score versus say what might be considered in the marketplace as an excellent credit score. The interest rates for FHA would indeed be lower. Does have higher debt to income ratios, and which is also can be a major caveat or a major compelling reason to use FHA versus other loan programs. Offers 15 and 30-year fixed mortgages, down payment assistance, virtually all the down payment assistance programs that we talked about, except the ones that are administered by Fannie Mae and Freddie Mac. And finally, you know, another excellent opportunity here, subject to negotiation, the seller can pay up to 6% of the sales price towards your closing costs, not to exceed the actual amount of the closing costs, the taxes, and the insurance. Next, we have conventional loan. It is a home loan that is offered or insured by a non-government entity. It is insured by a private mortgage insurance company. These loans are supported by Fannie Mae, supported by Freddie Mac, and down payments vary from anywhere from 3 to 5%. And they have a maximum debt to income ratio of like 49.99, subject to approval, versus FHA, which goes up to 56.99. USDA is another great program. It is a government insured loan that does not require a down payment, but it is restrictive. It's restrictive with geography and where the home is located. It's also restrictive with regards to median income and family size. And the DTI, well, it's pretty restrictive, 29 versus over 41. And finally, one of my favorites, VA loans. It's offered to current service members or honorably discharged service members, does not require a down payment. It does not have private mortgage insurance. It may or may not have a funding fee, but it does have lower interest rates than most other products. And it's very, very flexible for the veteran as it relates to the debt to income. So, hey, we're going to break here in for questions. But before we do, let's do a little trivia. And I bring this up because I had a situation recently, and I think it's important for me to share this with you. So the question is, what are acceptable sources for down payment? And I'm going to go through a list and drop me a yes or no, and give me your view on whether or not you believe the sources that will appear on the screen are indeed acceptable sources for down payment. So personal loans, what do you think? Drop me a yes or a no. Do you think it is acceptable? I will slow down, Derek. Thank you for that. Do you think that personal loans are acceptable as a source for down payment? Okay, let's do the next one. How about gifts from relatives? Yeah. Personal loans, no. Gifts from relatives, definitely. Stocks and bonds, for those who have it, not me. I mean, there's not, I think that's a pretty dishonest industry right there, unless, of course, if you have 401k, it's a good idea to maximize that. Stocks and bonds, yes, are definitely acceptable sources. How about loans on credit cards? I see Sheila says no. Derek says no. Definite no. Yeah, iPhone 3. Yeah, definite no, for sure. How about 401k? Yeah. 401k is definitely an acceptable source. I actually have a couple that I spent today on the phone with their 401k company, helping them, get the funds in a position so that they could get ready for their closing. Here's one of my personal favorites, cash. And it's usually under the mattress. What do you think? No, that's right. No. And you would have to introduce that cash into the market at some level, into the bank, and deposit it and let it season. If you had cash, it would not be an acceptable source of down payment. Hey, how about down payment assistance? Well, I think that's a given, right? Finally, what about IRS tax refunds? What do you think on that? Do you think that's an acceptable source? I believe that to be so. Yeah. So, the reason I bring it up is just as early as January of this year, I had a young man that was buying his first home. And, according to his bank statements, he had sufficient funds to close, and he applied with us. We got him pre-approved. We won the offer. We got the contract, and we asked for updated bank statements. And well, when we received the updated bank statements, my team found a large deposit from his existing bank, and it was a personal loan. And at that point, we sort of go into crisis mode that, we can't use this money And now we don't have enough money to close. And so thankfully, in his situation, we were able to get a gift for the rest of the down payment, because without that, we were already using one of Fannie Mae's products for down payment assistance, and without the gift from a relative, we wouldn't have closed. All right, so let's stop and do a couple of questions, and please drop me your questions. And I want to say thank you for being here this evening. And I'm also going to drop my calendar in the chat for those who might be interested in scheduling a one-on-one free consultation with yours truly. And I saw that someone asked a question earlier that before I could answer it, let's see what that was. One moment. Hey, sorry, Derek, for going fast. You know, it's called coffee. And I probably drink a little too much of that. So I had a question here. Could you be approved for use more than one down payment assistance grant? I wouldn't say that it's impossible, but I would say that it can be a challenge. I suppose. No. You know, because I think about this, that the way that they're structured, that means, hey, the way that they're structured is, unless it was, say, a city down payment assistance or a county down payment assistance program. In that situation, maybe where in those entities were not going to act as the servicer of the loan for the life of the loan. Many of the down payment assistance programs are offered by companies that want your loan to service it over the life of their loan. Let's see what we have. If we have money in a pillowcase, how long does it need to be in the bank account? Well, most people would tell you 60 days. I don't. I say 90 days. And here's why. When I take a loan application, in most instances, in rare instances, I may only need 1 month. But in most instances, I need 2 months worth of bank statements. And so I would think that you're going to need to let that money season in the account for the first 30 days, get a statement with the beginning balance that is agreeable with the ending balance from the previous statement and consistent. And then that, so that those 2 months that subsequent to the cash deposit, there's no evidence of that deposit for the lender to question. Let's see here, we have another one. A credit score of 500 is potentially a home buying option. Is that correct? It is subject to approval, but it does require, FHA does require resources for down payment in the form of 10% down. Does that answer your question? Please let me know. I have another here. Let's see, we've got, what is DTI? Good question. Yes, you're welcome. Thank you. A DTI is an equation that the lender divides all of your debt, including the house payment, into your gross monthly income and arrives at a calculation. I guess the best scenario is that if you had $1,000 a month in income and your house payment, you can tell I'm old, right? House payment was 500. My first house payment was 650. Hallelujah. What did I ever move? I know why. It's called marriage and wife and children. So let's say your mortgage payment is you know, your income's 1,000, your mortgage payment is 400, your credit card payments is 100. Well, that debt to income ratio is 50%. That makes sense. And there are two types of debt to income equations. There's one that we also, where we isolate just the house payment, and we divide the house payment into your gross monthly income and arrive at a calculation. Let's see, if one lender approves you at the highest interest rate, if you apply with another, could they give you a lower interest rate? Yes, they could indeed. And the 10% down, so I have a question here. Can, you know, if we're doing the lower credit score at 500, and really good question here. can you use the down payment assistance as part of the down payment assistance? And the answer, unfortunately, is no. The down payment assistance products that all the down payment assistance products that I'm aware of have a minimum 620 credit score. And those that there might be some city or maybe some county where they don't have a credit score requirement. But that's very, very rare, but you still have to qualify for a mortgage. But yeah, I would suspect that the answer to that in general and in most cases would be no. Wow. Okay. So terrific. Another good question. So buy downs, can you explain buy downs? Absolutely. So there's two types of buy downs. There's one that's called a temporary, and then there's one that's called a permanent. And a temporary buy down is you're buying down, you're paying upfront interest in both scenarios. I want to underscore that is they know that lenders, real estate agents, builders are using buy downs as sort of an enticement to get consumers to commit to buying a home. And hey, all of that's good. All of that's well and good. But me personally, doing 30 years, having been in the business 30 years, would I pay to buy down an interest rate? Would I let the seller do it? And that's what it's being used for. I have a transaction right now where the seller actually offered a dollar amount, said you can do a permanent buy down or a temporary buy down. So the way the temporary buy down works in the scenario that I just mentioned is the buyer elected to, with the seller's money, never makes sense to do this with your own money, at least on a temporary basis. And with the seller's money, he elected to, with a note rate of 6.6, but we used the seller's money to buy the rate down to 4.6 for the first year, 5.6 for the second year, and from year 3 through 30, the rate would be 6.6. And so that covers the temporary buy down. Now, a permanent buy down in his situation versus, and we looked at both, and we did an analysis and a side-by-side comparison of both, of the 4.6, 5.6, 6.6 temporary buy down. But we also looked at the idea of buying the interest rate down on a permanent basis. And what that means is we're going to pay interest up front for the benefit of a lower interest rate, not temporarily, but for the life of the loan. And so we ran the numbers, and the going rate for the day was like 6.6. And we were going to use the same amount of money that we used on the temporary. We were going to use it on the permanent buy down, and he would have gotten the benefit of 5.99. And instead of the 5.99 being fixed for 1 year, 2 years, it's fixed for the entire life of the loan. Okay, drop me a yes and let me know if that accurately and covers buy downs. I believe that that's a pretty good definition. Can you carry any old debt on your credit profile when you're trying to purchase a home? I'm not quite sure what you mean by that question. When you say old debt, generally, there shouldn't be anything on the credit report that is more than 7 years old, except for maybe a bankruptcy. I think the bankruptcies can stay on for 10 years. Now, that doesn't mean, however, that creditors don't report. And if I'm reading a credit report, I'm looking at the date that the item was last reported. And if it's beyond 7 years, it shouldn't be on there at all. I'm not sure if that fully answers that question or not. 1 second, let me see. I got another comment here. That was very informative. You're very, very welcome. Would you say the best route would be through DPA? What I suggest is the best route is what best fits your needs, because there's always a trade-off with down payment assistance versus not down payment assistance. And there are instances where the only solution, like in the instance I used earlier, the only solution for them was down payment assistance. But down payment assistance generally carries a higher than market interest rate. So if you're payment sensitive and you have the money, you may elect not to use down payment assistance. But the way that I do things is, look, it's about what we talked about, education. So what I believe it's important to educate you and show you the differences, the different options between down payment, non-down payment assistance, FHA, and conventional. And USDA if you qualify, but again, USDA is very restricted as well as VA. Let's see, did I miss anything? Let's see. So closed accounts. Okay, so in the credit report that you're referencing, closed accounts, nah, I don't think is, if the accounts are closed, I would just leave them alone. I think the best policy is to apply with myself. And I can't say important, I talk about, myself, and I'm quite confident about what I do and how I do it because it's the only thing I know how to do. And is apply. And let's take a look at the credit report together. And look, at the end of the day, I'm never going to say no. I'm going to say, here's a plan. And if we can execute this plan, we can make this happen for you. And I'll never forget in March of 2020, and I remember it so vividly because COVID happened like the next month or maybe the next week or something. But, I had a couple come to closing and they looked at me and they said, hey, do you remember us? And I went, no, I don't. But I knew that their mother had referred them to me, and I knew their father, and I'd done loans for their mother and their father. And I said, hey, we talked to you 5 years ago, but we were in Oklahoma. And then I remembered, and it was a couple that I'd spoke to on the phone, pulled the credit report, visited with them in a meeting. We discussed the credit report, we laid out a plan. And there we were, 5 years later, closing on their home. Let's see. Let's see, two more. So you're saying if debt is more than 7 years old, it can be removed? Yeah, if you can prove that. Now, when you look at a credit report, there is what is called date of last activity. And, if the date of last activity is more than 7 years, it shouldn't be on there. Or maybe when date of last activity, date reported, no, date opened. So there's some critical dates on there. If the date open is more than 7 years old, it shouldn't even be on the report. However, I can tell you that what some of the creditors do is they sell that debt and then they create a new date reported. And it's at that moment, that's where you really need somebody who is well versed on credit restoration to fight that for you. And let's see, do you really need to have $20,000 in the bank to buy a house? No, you don't. You don't. And I have some folks right now that probably, have under 10, but they're getting a combination of gifts and they're getting down payment assistance and they're going to be homeowners. It is so critical that if you can own a home today, that what it does, it'll establish housing security in your life and your family's life, but it also gives you a vehicle for building equity in an asset. All right, we're going to move on. Okay, mistake number 2, not getting pre-approved. Please get pre-approved, okay? I believe the time is coming where many sellers, many of their agents out there, if you're not pre-approved, they're not even going to look at your offer. And, and who can blame them? Because I can tell you that the biggest challenge I have every single day, every single week, every single month, every single year for 30 years is helping folks get their documentation together. And so I very much encourage you, when you apply with me, we give you a checklist of documents. And look, we'll even submit those documents to an underwriter, get you pre-approved, right? It puts you in a good position. But what it'll also do is it'll also make you aware of the documents that are needed to process your loan. Like I said, the biggest challenge for 30 years, the number one challenge is helping people put together their paperwork so that they can get approved for a home loan.
I can't do this anymore. I can't. I give, and you take. When I ask you to do something or even fix something for me, you just ghost. But oh, when you need money, you're all over me, like all stocky and weird. This is so not working anymore. I need my space. So whatever this even is, it's over.
Wait a sec. Does this mean you're not renewing your lease?
Ta-da! Perfect, thank you for that. Who wants to fire their landlord? Raise your hand. Somebody give me a hallelujah if they want to fire their landlord. Let's fire our landlords and let's become homeowners. And let's create housing security in the lives of our families and build some equity and build a basis, amen, and build a basis for having some wealth in our lives and legacy to leave our children and grandchildren. So we're going to talk about pre-approval, and pre-approval starts with.
I can't do this anymore. I can't.
Either. Sorry. Credit score starts with credit. So there's 3 C's as it relates to the mortgage process, mortgage approval process: credit, capacity, and we're going to talk about collateral as well. But let's start with credit. And we use FICO scores, and I was in the business before we used FICO scores. We didn't use scores, and you know what we had to do in those days? We actually had to read your credit report. And now, with the scores, I mean, I can look at a score and tell you within reason whether or not the credit is, quote, a 580 would be considered a poor score. 580 to a 669 would be fair. 670 to 739 would be considered a good score. 740 to 799 would be considered very good. 800 and above is exceptional. And a FICO score is just a computer-generated number that analyzes past and current history. And it's generally made up of 4 primary factors: timely payments, amount of debt you owe, and the number of credit accounts currently open, and finally, the number of credit inquiries. Now, another real item to be aware of is capacity, which deals with employment, deals with DTI, and employers today are finding a lot of very creative ways, and we're going to talk about the self-employment here in a moment, very creative ways for paying people. And what I would say is that when it comes to credit, when it comes to income, we're looking for stability as well as, do you make enough money to service the debt? So we mentioned DTI, but do we have stability? And generally, stability would be defined as a 2-year history on a particular job. However, do not let that discourage you, because if you're in a field where a professional organization, let's say you're an engineer and you graduated with an engineering degree and you went to work for an engineering firm, well, and that more than likely, because of the training in that field, I would not have to verify a 2-year work history in that situation, subject to how you are paid. And so if that engineer was paid commission, or how about if they were paid, they didn't have a guaranteed salary or guaranteed number of hours, then in that situation, they would indeed have to show a 2-year history, because despite having a 2-year history in the field substantiated with the education, I don't have a 2-year history of the variable income that they're earning to establish its stability. Now, the alternative to that is professional fields like nurses, teachers, civil servants, firefighters, police. Generally those professions have a salary and or an hourly rate that is definable and can be considered stable over a 3-year period. However, when it comes to commissioned income, 2-year history, automatic. Bonus, variable income, 2-year history. Self-employment, if you're self-employed, got to have 2-year history, 2 years tax returns with 2 years of income on the tax returns verified to qualify to service the debt. So I hope that I answered that question with regards to self-employment income. 2 years tax returns. However, there are alternatives in the marketplace, but we're not talking about those this evening. But there are something, if you want to make a note, it's called non-QM. And if you go to my website at mortgagemack.com, go up into the search bar and you can type in non-QM, NON-QM, and there are programs out there that will let you use bank statements to verify self-employment income. They'll let you use alternative sources for verifying income. But I can say this with certainty that the down payment is going to be larger and minimum generally 10% to 20%. And in addition, the credit score requirements are going to be substantial. So next is assets, money for down payment. We want to verify that you either have the money on deposit or we have a plan for getting the money. The lady that I'm helping right now, the plan has always been that we were going to take money out of our 401k. And so her loan was approved subject to her performing that action, and we'll get her loan ready to close once that money is received and verified in her bank account. In addition, finally, collateral. Collateral deals specifically with the property. We'll talk about inspections in a moment, but the collateral piece that we observe or spend the most attention with is the appraisal. Appraisal is an unbiased opinion of value based upon a licensed person's or licensed appraiser's analysis of the condition of the property and similar sales in the same vicinity as the subject property. So those are the 3 C's. And with that, we're going to talk about pre-approval. And a loan approval is a process where we actually focus on credit and capacity only because we don't have a property yet. And you apply, and then we go through the process of you supplying us your pay stubs, your bank statements, that sort of stuff. And then we turn the loan over to my team and we do third-party verifications of everything. And then we take that information and we submit it to an underwriter. And the underwriter in a mortgage company is the person with the authority to give us the green light to close your loan. Now, with that said, that the pre-approval, number one, will help you win an offer. And true story is, or let me just frame it this way. If you're a seller and you're selling your home and I come to you with a qualification letter, but hey, I'm offering you a slightly higher price versus say Amber or Derek or Destiny coming to you and saying, hey, you know what, I'm going to offer you a little less, but you know what, Mortgage applied with Mortgage Mack and Mortgage Mack approved our loan and our financing is in order. And as a seller, I got to believe that the vast majority of us would take what is in essence a guarantee that the loan is going to fund. So it ensures that your loan will close successfully and on time. It increases your bargaining power when negotiating, but it also increases your ability to win in a competitive real estate market. And it firmly estimates your monthly payment, your total investment, and clearly we will identify the product that best meets your needs during that process. So in essence, it's a process of not just getting approved with me, but it's a process of planning so that we have a super high degree of certainty that number one, you're going to win the offer, and number two, we have positioned ourselves to be successful and close on time. So to do or not to do, and these are some classic do's and don'ts, and we're going to talk about one of them. We're going to talk primarily about the don'ts, but I actually had somebody do a don't recently, and it has been a real challenge for them, unsuspectingly, unwittingly, and to me and my team, and to the seller, and to the seller. So not only were they buying a home from people that were selling a home, but they were also buying a home from somebody else that was selling a home so that they could buy a home. And it's created a lot of challenges, but let's focus on the don'ts. Don't make any large purchases. I encourage folks, don't make any large purchases before. If you're thinking about buying a home, wait. You know, I have people, hey, I'm gonna, I want to buy a car. I'm like, wait, buy a home, then buy the car. There's been so many folks that I've in my career that I'm like, wow, if we would have just bought the house before we bought the car, we could afford the home. And so I would just encourage you, buy the house first. Don't change bank accounts or make large cash deposits. We talked about that. Don't transfer balances in between. If you're going to get a gift, don't take the money. Just sit down and make a plan to how to manage that. Don't close any credit card accounts. They're just, even if it's an open account, don't close it. A lot of open accounts that are not being used actually helps your credit score. Don't consolidate debt onto multiple credit cards. And don't apply for any new credit cards. Don't apply for any loans. Don't co-sign a loan. We'll say it again. Don't buy a car. Buy a house first. Quit your job or change. And that's what I had recently is unsuspectingly, end of school year, moving to a new home in what would hopefully be a new school district. And the buyer unfortunately told the district that she was working in that she wasn't coming back. And they took that as a resignation. And we always verify. We always verify your employment just before closing, up to 3 days before the closing. And we verified her employment and they said she had resigned. And so that is, hey, you know what? We can't close. And so we've spent 3 weeks finding another job. Hopefully we're going to close this week next. So it seems that it's all going to be to work out, but you know, but at the same time, we have multiple families that are being impacted by this. And it's just been immensely stressful for everyone. The next mistake number 3, using your bank. Hey, have you ever heard this saying? Because I've heard it my whole life. It said, banks lend money to people who can prove they don't need to borrow it. If you've heard that before, let me know. Banks and credit unions are usually slow to process. You know, I have a loan with a bank right now, and I have to use the bank. I'm using an outside bank as a specialty loan for a specialty type of situation. And look, they are in no hurry. And I'm in a hurry from the time that I wake up to the time that I sit down. It's because that's the way my industry is. And I genuinely want to serve the needs of the people that I work with. They can also, large banks generally have a lot more clients. You know, I have maybe at any given time 6 or 12 that I'm working with. I know you by first name. They know you by a number. They can also have much stricter guidelines, kind of like the story I was just showing moments ago, where I'm waiting on this bank to give me the go-ahead to close this loan. And, you know, it's just, you know, they do a specialty type loan, but they're very strict with it. And as I said, the process moves so much slower. And, you know, you have contractual obligations when you are buying a home. And if you don't fulfill those contractual obligations, the seller can keep your money. Now, true story I had probably 15 years ago. So I've been doing this a long time, but I'll never ever forget the phone call I got with it's the wife on the line. She's calling me. I can hear the husband and the children in the background. And the story goes like this. Mac, we sold our home. And we had a qualification letter from our bank. And we were supposed to close on the home that we were buying today, but we didn't. And now we're at a hotel, and the moving van is in the, so get pre-approved and make sure that you work with somebody that has reviews and that is trustworthy and knows what they are doing. So, hey, banks and credit unions. Well, you know, from my perspective, and in today's world, reviews matter. And if you can catch my QR code, I think I'm up to 90, almost 100 on Google and another couple of dozen in other places. I believe that when I got in the business 30 years ago, we understood that we were in an industry whose purpose was to offer a path to homeownership for the American public. Mistake number 4, buying directly from a builder. You know, hey, builders and their lenders, they work together and say they're in cahoots. I would say they're in cahoots together, no doubt about it. I remember when builders were not allowed to own their mortgage company, and builders told politicians, they said, hey, if you'll let us own our mortgage company, we're going to pass the savings along to the consumer. I mean, come on, man. I mean, I would just repeal all of those laws just because they lied to me at this point. But let's just say that on rare occasion, does it really, and it's not every occasion, but there's many occasions where it's not better for the consumer, because I assure you that everything they give you is included in the price. But by the same token, you have to go, if you go look at new home communities, you got to go with your real estate agent. And if you don't have one, let me know. I know that they'll offer closing cost assistance, but many times, not all the time, many times it can be a bait and switch. I'll tell you a true story here in a minute. Your real estate agent will help you understand the builder's contract. I promise you the builder's contract is designed to their benefit. And, you know, it's like, hey, if you're going to buy a new home, when you get ready to sign, you need to make sure that you know that this is the right thing for you. Because if you figure out later that it's not, there's no going back. Usually with the builders, there's no going back. They are going to keep your money. And I'm sure there's exceptions to the rule, but I can give you 3 people's names and phone numbers where that was not the case. Your real estate agent works for you. The sales agent works for the builder. And finally, your agent is knowledgeable about the walkthrough process. True story. I had a young real estate agent that referred this buyer to me, I think it was last year. She told me the story where she bought a home from a builder, and she worked with the builder's lender, which is Mack. She worked with a builder's lender, and you know, they pre-qualified her, told she was good to go. But they had 6-7 months to build a home. They built the home, and you know, she's giving notice to her landlord because she's moving, she's packing, and guess what? She didn't close. She did not close. And I listened to her tell me this story, and I'm just mortified. And that the builder ended up, and it's a national builder, kept this person's money, kept $7,000 of her money. She had to beg her landlord to let her stay in the house because she had kids. I mean, don't ever go shopping for new homes without a real estate agent. Hey, some of the things to be aware of, and not always the case, but you know, I did have a situation recently where a young man came to me, and definite predatory lending with a builder and their mortgage company. There's just no other way to describe it. But builders, lenders, one of the things that builders, lenders that I find don't offer is they don't offer extended rates. And what an extended rate is if you're buying a home from the ground up, it's going to take 6-7 months to close on it, for it to be finished. I can't close on it till it's finished. And so, can you lock your interest rate in today on a home that's going to close 6 months from now? Yes, but it's going to be more expensive. And most builders, lenders will not offer you that. And the reason they won't offer you that is because if you lock in your interest rate, well, that's a drop dead date where the builder has to have the house done. And most builders do not want to have to operate under those pressures. And so that's why they tell you, you have to use our lender, and our lender will tell you, no, we don't offer extended locks. And that you need to call Mortgage Mack. Because I can tell you, I had a couple I met in December, I think it was 2021. They contracted on a home in March of 2022. Rates started going up, and you know, the real estate agent told them to call me, and they did. And we had this conversation, and we locked their interest rate in for 8 months, for 9 months. And I think I locked them in at 4%. And I went to their housewarming party. I was a special guest, because all of their neighbors who worked with the builder's lender were paying in the mid-6s. Rates in October got up to 8%. Some of them were paying 7.5%, and they were not even offered the option to lock in their interest rate. So get a second opinion. Many of their fees that they say, what are the fees relative to the incentives? Because many builders, they may say, hey, we're paying this for you, but actually I've had builders over in my career say, hey, Mac, if you'll pay for the title insurance, we'll let you on our list. And I'm like, pay for the title insurance? I don't make enough to pay for what the title insurance would cost for this home. So the only way for me to pay for it is I have to raise the interest rate. And to me, that's intellectually dishonest, and it's not beneficial to the consumer. What is their interest rate relative to the incentive? So that's another good question. You know, got to get a loan estimate from them. You got to get their numbers and make them and hold their feet to the fire and get it in writing. And I would also do a Google search on builders, do a Google search on their mortgage companies as well. Mistake number 5, skipping a home loan inspection. Now the objective of a home inspection is to cover structural safety issues, including roof, plumbing, electrical, exterior, safety, foundation, and much, much more. And more importantly, the inspection is indeed the buyer's responsibility. Some of the challenges or consequences of skipping a home inspection: you could unknowingly inherit costly repairs. You could lose negotiating powers. Not you could, you will lose negotiating power during the option period. You need to be aware of all safety concerns. A true story. I had a couple call me at the end of this past year. They bought a home, they'd been in it, and they started feeling sick. They had somebody come out and inspect, and they found mold. And not only was it just mold, but it was a kind of mold that was unhealthy, and they were told they needed to move out of their house. And so they called a real estate agent that they met at their church. Their real estate agent referred them to me. And, you know, at that moment, what do? I mean, you bought your home, you got a mortgage payment, you're being told you got to move out. You're being told that your home is only worth half of what you paid for it today because of the mold. And you're told that the only way to get rid of the mold is you have to spend $55,000. And oh, by the way, you got to move out. Yeah, you got to do a home inspection. Your risk is inheriting structural and non-structural defects such as foundation, electrical, plumbing, heating. And you also miss having a forecast of future repairs. And a good forecast is, you know, hey, look, if a roof is good for 5 years or more, that's a good roof. But if you do a home inspection and the inspector says, hey, you know, you got 5 years left on this roof, you got 7 years, then, you know, that's a good basis and a good foundation for you to begin to plan your finances, knowing that, hey, in 5 to 7 years, I need to have the money set aside to put in the roof. And so what are the next steps? Well, first, you could apply if you want. Here's a QR code to mortgagemack.com. You could go there and apply now, or you can visit if you'd like to schedule a one-on-one, free, no obligation consultation. But I can assure you this: if you apply with me, we don't do a hard pull. It's a soft credit report, and I'll email you a link to my calendar, and we'll hop on the phone and spend some quality time together. Spend an hour together, and I encourage folks to bring a property to the meeting that we can review. Use it as a test case for the numbers to see, hey, does this fall within the framework of your expectations? Does it fall within the framework, of what we can qualify for? And as far as payment, and does the cash to close for down payment, closing costs fall within the framework of, again, your expectations and or resources that we can help you get with down payment assistance? And finally, hey, let's go home shopping. And, you know, if you don't have a real estate agent, I have some that I highly recommend that would be delighted to help you. But again, I would encourage you to get pre-approved first. And so, how you feeling? Drop me some notes in the chat session and let me know. Are you feeling better? Maybe a little bit relieved, feeling maybe empowered or maybe confident? How about, hey, it's all good, I'm cool. Hopefully I've encouraged you. My hope is help to create, you know, a level of education so that you feel empowered. Now that's how you make good financial decisions. You educate yourself, and together, at the very least, we will look at the numbers and we'll do it in an accurate way. I'm compelled to offer the people that I serve accurate numbers, and so that they can make good decisions. Because, you know, at the end of the day, I want to know that, you know, after all of the years of having been in the industry, which is what I love to do, is that I've helped people genuinely create wealth and housing security in their life. Thank you. Good. Good to hear it. Glad to hear it. Satina, thank you for that. On. Absolutely. You can ask as many questions. That's what we're doing right this moment. And I am all yours. Let's see if I missed a couple of questions. I say, what is the loan for a fixer upper? I see that. Well, good question. Good question. So we call them renovation loans. And it's generally, you can do their FHA has one, it's called a 203K renovation loan. And conventional has one, it's called Homestyle. We do all of the renovation loans, and you know what we do? We do them well. And I've been able to help people buy homes and do their own renovations. And, you know, they walk in with lots and lots of equity, and the mortgage that we give them, the interest rate is much cheaper than it would be than if you say did a home improvement loan. And, you know, and if the house is in really disrepair, you can actually get, you know, finance up to 6 months worth of mortgage payments and and not have a mortgage payment. That's pretty wild too. Hey, thank you for that. Feeling much more informed. I appreciate that. You know, I do have another good webinar I almost bought from a builder. Hey, yeah, got to be careful with that. You've got to make sure you have a real estate agent with you when you go out there. And you know, not only do the agents want to help you, but they're obligated to help you. And they actually have formal agreements that they contract with you now, and that says, hey, you know, they're kind of like a lawyer for you. And you know, can't say enough how important it is to have good people and a good real estate agent and a good lender. The way my agents and I work together, we believe that we are partners in our relationship with you to act in a manner that is beneficial for you at all times. Hey, you're welcome for the information. You're welcome. Hey, you know what? It would be delighted. I'm going to stick my I'm going to put my one-on-one consultation here. Please feel free to log or click on that link, and you know, and let's just visit. And if there's no time on my schedule this week because I get busy, there should be some time on there. There should be. I'm not that busy this week, so just lots. It's end of month, and we have lots and lots of closings. But absolutely, please book some time. Where was I going with this? Forgive me. Great, thank you. Talk to you soon. And you know what? If you go to my website, I'm going to give you my website too, www.mortgagemack.com. And I actually have a free guide on my website for you. It's a free homebuyer guide. And give me one moment. Now I'm going to put this in the chat for everyone. It's a really decent guide. Let me see, let me find it. They move stuff. My IT department moves things regularly. Here we go. I'm going to drop this in the chat. Here we go. Sorry about that. Took a minute. If you get a pre-approval letter and the lender says the interest rate is not set in stone, but is on the pre-approval letter, what happens? Well, you know, if you have just a pre-approval letter, generally lenders will not let you lock the interest rate until you actually have a contract and a specific closing date. So that's probably is why the interest, that's why they're telling you that. But we do have an option called lock and shop. But I can tell you that the way that the lock and shop works is we'll let you lock in an interest rate for a 90-day time frame and let you go shopping for houses. And if rates go up, you're protected. And if rates go down by a quarter point or better, we'll give you the better rate. Pretty good deal. So in our instance, you don't have to have a property, but that's what that lender's telling you. They're like, hey, we can't lock your loan till you have an address and we know what your closing date is. Come on, any more questions? Let's see, how about this one? We talked about how much should I save for a down payment? You know, I think it's a good idea to, you know, clearly there's more than down payment. There's down payment, there's closing costs, there's taxes, there's insurance, there's interest. You know, at the end of the day, you know I shake my head having known, you know, what I saw 30 years ago versus what I see today. There's just a lot of hands in the pot, a lot of hands in the pot. You know, so, you know, it would probably, I would suggest, you know, it's, you know, because it's more than down payment, it's closing costs. And generally, if you don't have any money saved at all, it can be a real challenge. So having some of your own money, even if it's say 3% or even 5% of the price, is really going to open doors to you, because the down payment assistance that's available, it's only 3 to 5%. And I can say with a great deal of certainty that it's going to be more than 3 to 5% once you add closing costs, taxes, down payment, and you know, hey, we're not in a buyer's market, so still not a buyer's market, so it's hard to get seller contributions. And so it's a good idea to have some money saved, unless you qualify for USDA or VA, which, hey, on USDA or VA, there's no down payment. And, you know, hey, we can get enough down payment assistance to cover the closing costs and the taxes on that. So it's not impossible. You get a pre-approval lender, or read that one. For married couples, both parties have to be on the loan. Well, not on the loan. So true story, you know, when Texas used to be its own country, I did a blog on this several years ago, maybe 2017. And I had to do some research and study what are called the community property laws for the state of Texas. And we put these community property laws in our Constitution many eons ago, to protect immigrants from places like New York. But we also put in community property laws, or we put some of the lending rules to protect immigrants coming from other parts. But we put a community property to protect the spouse in that day and age. So, so for married couples, not both have to be on the loan. But FHA, if I'm doing an FHA loan for you and you're married, I do have to do a credit report on both husband, wife, on your partners, right? I have to do it on both legal partners. I have to pull a credit report because FHA recognizes, and the government, that would include USDA, VA, and FHA, they look at not just community property, but they also look at community debt. Now, on a conventional loan, it's separate, but hey, just like FHA, just like conventional, or just like FHA, USDA, they all recognize the community property ownership idea. And that if you're married and you're buying a new primary residence, your wife doesn't necessarily have to be on the loan, but she does have to sign, or he does, or your husband does have to sign the deed of trust. I hope I get that. I have a tendency to over-explain things. So if you know anybody that needs a good radio guest or Facebook Live guest, or want to talk about mortgages, I can talk about mortgages all day. Is credit more important than down payment? You know, I would say there is instances where credit can be more important, yeah, than, you know, if I have a 680 credit score, I can work with that, right? If I have a if I have, you know, under 580, it's really difficult, right? And that, or let's say, for instance, if to get down payment assistance, you got to have at least a 620. So I think it's a good idea to have a good combination of a good credit score, some money and some money saved. I think that a good strategy would, if you believe that you could improve in both areas, it's a good idea to work on both. How was that? Give me a thumbs up, please, if I answered that for you. Let's see, what happens if I change my mind after we started the buying process? Nothing. And there's no obligation until you actually get to closing, not with us. But there could be some obligations if you had a contract. If you had a contract with a seller, great, thank you for that, thumbs up. If you had a contract and you back out of that, the seller can keep your earnest money, just like the builder would keep your earnest money. And hey, there might be some expenses, appraisal, inspections, just really depends upon how far in the process you get. What are closing costs? Well, closing costs generally are fees that are paid to either directly to the lender for the processing of the loan, and then you have fees to third parties that are associated with reporting that the lender requires, such as credit reports, appraisal reports, survey reports, title reports. It's all reports, and those and all of those entities, either invoice us or participate in the closing process, such as a title company. And, so all of that goes to make up closing costs. And then separate from closing costs are taxes, insurance, and interest. And, if taxes include the taxes to put deposit into your escrow account to pay the taxes for you. It can include into your insurance is paid in advance for 1 full year. So there you go with insurance, plus an additional 2 to 3 months get deposited into your escrow account. So closing costs just really, really covers a lot of different items, and I'm amazed just regularly at the sheer number of entities that participate in this process today versus when I got into business a long time ago. But I can tell you this, and I believe this, that I was in the business. I've watched the industry change over many, many years, and I believe that it's better for the consumer today than it was not when I got in the business. When I got in the business, it was, we were very consumer oriented. It changed when they let the bankers and the Wall Street types into the industry. That's when things really began to change in my industry in a negative way, to the degree that the federal government had to go in and re-regulate my industry. But the bankers and the Wall Street types are still in the business. If you ask me, they don't belong in my business. And if you're a banker or you're from Wall Street, I'm proud, sorry. What else we got? Any more questions? Let's see if I got a couple more written down here. How do you know if you're ready to buy? Well, 21? I have a 21-year-old getting approved to buy a home right now. How about that? She has credit. She's been working with her family. Their families, she comes from an immigrant family, and they believe in home ownership. And they've been working with her to help her in her business. She has a business where she makes reasonably good money, and she's been saving her money, and she's 21 years old and going to buy a home. So I think that when you're ready, one of the exercises that I encourage folks to do, if you don't budget your money, you should. And the good way to figure out how much you can afford is just to take all the net money that you make every single month in your job. And if your income is not predictable and it's variable, then I would say average it over a 12-month or a 24-month period. deduct all of your expenses, your credit card payments, your cell phone bills, your food, your Starbucks, your eating out, and try to come up with a figure of money that's left over every single month. And then begin to deduct from that figure emergencies. Hey, what if I have, what if the refrigerator breaks? So subtract, I would say, whatever you feel comfortable with, that, because you don't want all of your expenses and the mortgage to take up all of your money. You gotta have something left at the end of every month. I read a statistic that post-COVID that, a lot of Americans today are literally living on credit because they have shortfalls every single month. And I really would encourage folks, don't do that if you can avoid it. And the best way to do that is know how much you bring home. And if you know how much you bring home, then you can begin to figure out how much of that you can devote to a mortgage, how much of that you can devote to repairs, and how much of that you can devote to retirement and devote to emergencies, and the rest is for mortgage. Another thing that I think is going to be really critical, and I'll share this, and as long as you're with me, I'll be glad to chat. And if you have any other questions, let me know. I've been working on a platform that I call Mortgage Matchmaker, and my idea is to introduce a social platform where people can get online to know each other to a degree that, hey, they'll be willing to go into a financial relationship. I call it marry the house, not the spouse. What do you think? Drop me a thumbs up if you like that idea, where people can get in a social format, get to know one another, and develop a friendship and decide whether or not they can afford or want to buy a home together. Because it would be really, really genuinely good for both parties that if they could buy in a neighborhood that would serve the needs of children, serve the needs of their employment, and give them home ownership that would allow them to develop equity that they can share with their children and grandchildren at some point in the future. Well, how was that? You think it's an excellent idea? I think it's an excellent idea. I wanted to call it Mortgage Matchmaker. I was going to call it hashtag M5. What do you think of that? But I'm like, no. We just call it hashtag M3, Mortgage Matchmaker, and just a social platform where professionals might get together. I've run into lots and lots of teachers, lots and lots of nurses that are single. Many are single moms, and I gotta believe that in the very schools that they're working in, or the very hospitals that they're working in, that there's other people that are similar situations as them. And all I would want to do is use the application to connect them, let them get to know one another. Clearly, they're not going to get married, but they're going to have a legal agreement that governs their relationship as it pertains to the ownership of a home. And I think it would be a solution for some people. So, any other questions? Hey, what's a good way to determine how much home I can afford? Just because I'm pre-approved for a certain amount, does that mean I should accept that? No. And I'm of the mind, and I encourage folks, when you come to my appointment, bring a home that you think you would like. And let's start there. And because if you start there, I can use real insurance, I can use real taxes, and we can measure that and where that falls with respect to your qualifying. And look, and if there's room for you to build on that, then, hey, we'll discuss that. And so that, hey, if you qualify for, 400, but you find something at 450, we can also discuss that. But I generally pre-qualify and pre-approve people based upon a specific property with a specific profile. And it's almost always a property that they're interested in owning. So what I don't do, I guess is what I'm saying. What I don't do is what we did 30 years ago when we didn't have the internet, and all we really could do is guess. And So I think, if I were you, I would find a home that you're interested in purchasing. And just because I'm pre-approved for a certain amount, does that mean I should accept that? No, you don't have to accept that. You don't have to accept that. And I hope I answered that question though. Hope I answered that question. But I do things differently. I just don't do things like that. Yeah, I just don't do things like that. I think it's incumbent upon me to, especially with so much information available, that if you can come up with something, let you look at houses, go online, look at houses. And thank you, look at houses and that you might like, and let's use that as a foundation. And that foundation, we can either build on it or we can make it smaller based upon what you believe that is good for you, because this is really about you. It's about helping you make good financial decisions. So that's why I believe it's important for me to do the numbers up front with you and to be accurate so that you can make good decisions for you. And then, clearly I'll throw my 2 cents in there. If I think, have, one of my children buying a home and I throw my 2 cents in there, I'm like, why you want to buy that big a house? But, hey, that's dad. It's like, why do you want to buy that big a house? And well, I appreciate that you like the way I do it. I think it's different, and I think it's oriented to serving the public, and that's what we're interested in doing here at Team Mortgage Mack. Any more questions? Well, I just want to say thank you for being here with me this evening. I've enjoyed your time. I look forward to visiting with each and every one of you. Please, if you don't, I'm going to pop this calendar event. Hey, you are very welcome. You're very welcome. And I do this once a month. It's usually the last Tuesday of the month. I'm going to make a recorded version. And if you want a recorded version, send me a text message and I'll make sure you get a recorded version. And if you have any friends or family members, please share the recorded version with them or send them to the next event. Let's make sure that we connect again in the future. And I wish you a very good evening. And again, thank you for your time. And I hope that I was able to be helpful to educate and empower you so that you can begin your own home buying experience. Have a great evening, and we'll talk again soon. Bye-bye.